Hey everyone, and welcome back to our channel. Are you ready to crack open the history books and dive into some juicy financial drama? Today, we're not just talking about your average stock market hiccups. We're talking full-blown economic meltdowns, the kind that make grown investors sweat. But don't worry, this isn't just a history lesson to make you feel bad about the economy. We're going to dig into these disasters like financial detectives, figure out what went wrong, and learn from the mistakes so you don't have to make them yourself. The late 1990s witnessed a dramatic economic upheaval in Southeast Asia with the eruption of the Asian financial crisis. Characterized by currency devaluations and economic contractions, the crisis exposed vulnerabilities in the financial systems of regional powerhouses like Thailand, Indonesia, and South Korea. In Thailand, the epicenter of the crisis, the Thai baht plummeted over 50% against the US dollar, plunging the nation into severe recession. Indonesia grappled with a sharp 13% GDP contraction in 1998. Along with soaring corporate defaults and a surge in poverty, South Korea, a major economic player, faced a significant downturn marked by a 20% decline in industrial production and rising unemployment. The root causes of the crisis were multifaceted, primarily driven by speculative attacks on local currencies and excessive foreign currency borrowing by businesses. These factors left economies highly susceptible to currency fluctuations, leading to increased insolvency risks. International cooperation became crucial, with the International Monetary Fund providing comprehensive financial packages aimed at stabilizing currencies, restoring investor confidence, and implementing essential structural reforms. Additionally, currency controls and austerity measures were implemented within affected nations to address fiscal imbalances and stabilize their economies. The crisis underscored the critical importance of sound fiscal policies, transparent financial management, and robust regulatory frameworks. It highlighted the need for international cooperation during regional financial turmoil, emphasizing coordinated efforts to prevent contagion and stabilize the broader region. Looking ahead, countries are urged to diversify their economies, strengthen financial regulations, and implement early warning systems to detect vulnerabilities and prevent future crises. The 2008 global financial crisis, or GFC, wasn't just a tremor, it was an earthquake that reshaped the financial landscape. At its epicenter stood the collapse of Lehman Brothers, a financial giant whose fall exposed intricate weaknesses within the global financial system. This domino effect triggered a cascade of economic woes impacting nations worldwide. The fallout was swift and severe. Global GDP shrank by 0.8% in 2009, marking the worst recession since World War II. Stock markets plummeted, with the Dow Jones Industrial Average suffering a historic 77% decline. The U.S. housing market, riddled with subprime mortgages, imploded, propelling unemployment to a staggering 10%. Lehman Brothers' demise, the tip of the iceberg, unraveled the interconnectedness of financial institutions and instruments, freezing credit markets and triggering widespread panic. Governments facing economic Armageddon adopted extraordinary measures. The U.S. unleashed a $787 billion stimulus package, while the Federal Reserve slashed interest rates to near zero and pumped trillions into the financial system. International cooperation led by the G20 aimed to prevent a global meltdown through coordinated action. The GFC's legacy transcends immediate recovery. It exposed the need for robust regulatory frameworks, including tightened oversight of derivatives and complex financial instruments. Risk management practices within institutions were revamped, with stress testing emerging as a crucial tool to identify vulnerabilities before they snowball into crises. The crisis also highlighted the global nature of finances, demanding enhanced international cooperation and information sharing to navigate future turbulence. The 2008 GFC serves as a reminder of the interconnectedness and fragility of the global financial system. By heeding its lessons, strengthening regulations, promoting responsible risk management, and fostering international cooperation, we can build a more resilient financial architecture capable of weathering the storms of a dynamic and interconnected world. The early 2010s were marked by a complex financial challenge, the European debt crisis, triggered by high public debt and weak economic fundamentals in several Eurozone countries. It exposed the fragility of a shared currency without a unified fiscal policy. Greece, ground zero of the crisis, became a stark example. Its soaring debt, exceeding 130% of GDP, led to severe economic contraction, social unrest, and deep hardship for its citizens. The domino effect quickly spread to other nations like Portugal, Ireland, Spain, and Cyprus, revealing the interconnectedness of Eurozone economies. The lack of centralized fiscal control made it difficult for these countries to address their debt burdens, forcing them to rely on external bailouts and implement stringent austerity measures. While these measures brought some stability, they came at a hefty price, with many facing cuts to social services, rising unemployment, and deepening resentment. The crisis wasn't just about numbers on a page, it was about people struggling to make ends meet, businesses collapsing, and dreams deferred. It highlighted the challenges of balancing fiscal responsibility with the well-being of citizens. In response, the European Union implemented reforms, including stricter budget rules and closer economic surveillance. The creation of the European Stability Mechanism aimed to provide a financial safety net for future crises. While the immediate threat subsided, the long-term scars of the crisis remained visible. It served as a stark reminder of the delicate balance between economic integration and national autonomy, and the importance of fostering sustainable fiscal policies within a shared currency zone. May 2010 saw the US stock market witness a heart-stopping event, the flash crash. During this 36-minute roller coaster, the Dow Jones plummeted a staggering 777 points, only to recoup most of those losses just as quickly. While brief, the event sent shockwaves through financial circles, exposing the potential hazards of high-frequency trading, or HFT, and market fragmentation. At the heart of the crash lay an intricate dance of automated algorithms designed to execute trades at lightning speed. HFT programs amplified existing market movements, turning a modest sell-off into a free-fall. Fragmented markets, where orders are routed through various exchanges, compounded the chaos, adding layers of latency and confusion. The numbers paint a vivid picture of the crash's intensity. Within minutes, trillions of dollars in market value vanished, leaving investors reeling and questioning the market's stability. This episode exposed the potential downside of HFT and the vulnerability of fragmented markets to unpredictable fluctuations. The wake-up call was loud and clear. Regulators scrambled to implement safeguards, including circuit breakers that temporarily halt trading during sharp drops and measures to limit the speed of certain algorithms. Enhancing market transparency and strengthening oversight of HFT practices became priorities. The flash crash serves as a valuable lesson. Innovation in the financial realm, while beneficial, demands responsible management. Striking a balance between technological advancement and risk mitigation remains a crucial challenge. As markets evolve, regulators must adapt, continuously refining their frameworks to ensure stability and protect investors from the unpredictable dance of algorithms. The Roaring Twenties, a time of exuberant prosperity, abruptly slammed into the brick wall of the Great Depression, casting a long shadow from 1929 to 1939. This unprecedented economic crisis, marked by widespread unemployment, poverty, and social unrest, left an indelible scar on generations. Triggering the downward spiral was the infamous stock market crash of October 1929. Black Thursday witnessed fortunes vanishing and panic gripping the financial system, sending it into a tailspin. Deflation further choked the life out of the economy, creating a vicious cycle of falling prices, plummeting demand, and shuttered businesses. Jobs evaporated, leaving millions in the throes of poverty. The crisis wasn't confined to America. The Dust Bowl, a devastating environmental disaster from 1930 to 1936, displaced farmers and deepened the economic misery. Fearful nations raised trade barriers, further crippling international commerce and trapping the world in a deflationary spiral. President Franklin D. Roosevelt's New Deal, launched in 1933, aimed to fight back. Public works programs provided jobs, social welfare reforms alleviate suffering, and financial regulations sought to prevent future disasters. While recovery was slow, it was the unexpected catalyst of World War II that finally pulled the global economy out of the abyss. Increased military spending stimulated production and employment, marking the end of the Great Depression's reign of terror. The Great Depression may have ended, but its legacy endures. It reshaped the political landscape, strengthened social safety nets, and left lasting economic ideology still felt in the 21st century. This dark chapter in history remains a sobering reminder of the cyclical nature of economies and the importance of responsible policies to weather future storms. From Roaring Twenties greed to the 2008 meltdown, market crashes tell a familiar story. Speculation runs wild, regulations get ignored, and our interconnected world wobbles. But hey, learning from history isn't a crash course in misery. Let's be smart with our investments, demand solid rules of the game, and navigate the financial roller coaster like a pro.
The best thing you can do is be exceptionally good at something. Want to start the new year with a keen financial mindset? Here are some ways you can invest to build wealth fast in 2024, according to Warren Buffett. Warren Buffett once said, "The stock market is designed to transfer money from the active to the patient." His comments are timeless. This wise counsel, along with thoughts from financial icons like Ray Dalio, Susie Orman, and Robert Kiyosaki, among others, sets the backdrop for our video into the most cryptic investment strategies. Let's reveal the tactics and ideas that have led these visionaries to financial success this year. The Investment Guru. For almost 70 years, Warren Buffett has been making investments. He's been in charge of Berkshire Hathaway, a holding company for numerous companies, for the past 50 years and is currently the 5th richest person in the world. We can all benefit from his experience as one of the best investors of all time. A wise starting point would be to look at his 2024 investment strategy and locations. Buffett revealed where he's investing as of the beginning of this year in his most recent portfolio modifications, which were disclosed in November. He owns stakes in several well-known brands, including Apple Inc., Coca-Cola, Bank of America, and MasterCard. And his portfolio spans a variety of industries, including energy, information technology, and finance. Takeaways from Buffett's portfolio. The best results come from studying the best. Before you start investing, you should know how the Oracle of Omaha invests and maintains his portfolio. Let's take a look at the portfolio of Warren Buffett. Number 1. Variety. Buffett would be among the first to tell you that building a diverse portfolio is the key to successful investment. You should always have something going for you if you have a sizable enough variety of investments. Over the years, Buffett and his analysts and experts, including the late great Charlie Munger, have constructed a diverse portfolio. Buffett has made investments through managing Berkshire Hathaway across a range of industries, nations, and business sizes. Using the global stock market as an essential reference is a smart place to start when constructing your portfolio. After that, you can choose which regions to invest more in and which to avoid. Almost 2/3 of the global stock market is held by the United States. In contrast, the UK accounts for only about 4% of this, yet the US does not account for roughly 40% of the worldwide market. Maintaining a diverse portfolio of investments across multiple nations contributes to overall well-being. Number 2. Period. Stock markets and share prices sometimes respond to transient noise. Emotions among investors may surface and share values may diverge from the actual value of the business. For investors, understanding the distinction between price and value is crucial. It's critical to remain calm and invest for the long term, which is at least 5 years when it seems like the markets are going south. Buffett also took some time to reach billionaire status. Investing requires a test of guts, knowledge, and experience that cannot be purchased. Over time, the markets usually calm down, and Buffett's portfolio is an example of that. Buffett's Berkshire Hathaway has had its worth decline by more than 30% 6 times between 1979 and 2019, while holding a diverse range of businesses. In the beginning of 2000, Berkshire lost 44% of its value. Number 3. Examine your portfolio. Investors like Buffett periodically reviews their portfolio, make any necessary adjustments to their holdings, and confirm if their long-term investment strategy still makes sense. Berkshire Hathaway's investment portfolio is actively managed, so the company regularly adjusts its holdings as opportunities arise in the market. Ideas for investments in 2024. Now is the best time of all to begin investing. One of your resolutions for this year could be to put these teachings into practice. Purchasing many distinct individual shares can be costly and challenging to manage if you don't have the benefit of a staff like Buffett supporting you. Using funds is one of the finest ways to diversify a portfolio. They provide a simple means of making investments across industries, asset classes, and geographical locations. Number 1. Navigating innovation. The technical landscape is still developing in 2024, offering many intriguing opportunities. Consider devoting a percentage of your capital towards innovative sectors such as artificial intelligence, renewable energy, and biotechnology. Businesses that are at the forefront of these fields are well positioned for sustained growth, and investing in cutting-edge technology can provide them a competitive advantage in today's fast-paced marketplace. Number 2. Ethically sound investing. One trend to watch in 2024 is the growth of sustainable investing. Investigate investing in businesses dedicated to social responsibility, environmental sustainability, and sound governance principles. In addition to having a good influence on society and the environment, ESG investments support the increasing need for financially responsible, socially conscious choices. Including sustainable investments in your portfolio diversifies it and shows that you have a forward-thinking mindset that considers both financial gain and good social effect. Number 3. Protective techniques. Seeking consistency in medical and retail. Examining sectors recognized for stability and adaptation is a wise move amid economic uncertainty. Consumer staples and the healthcare industry are defensive industries that have historically proven resilient in trying times. You can build a strong portfolio foundation by investing in reputable businesses in these industries, which will provide stability and possible profits even during economic ups and downs. Number 4. Careful study and well-informed decision-making. Complete research and well-informed decision-making are the cornerstones of a successful investment strategy, regardless of the particular industries you select. Keep up with market developments, investigate possible investments thoroughly, and consult financial professionals for guidance. When you start your investing adventure in 2024, make sure your investment strategy is tailored to your financial goals and risk tolerance in order to ensure a dynamic and well-balanced portfolio. Key lessons from Buffett. Becoming rich does not only involve building a diverse portfolio, there are certain things you should keep in mind. We can extract key lessons from Warren's advice and experience. Number 1. Keep your eyes on the big picture. Don't get lost in the details. In a letter to shareholders, Buffett stated that rather than concentrating on the specifics of the numerous and varied businesses a corporate group may be managing, investors should focus on the overall big picture of the group. If everything is going well in the group, you don't need to assess the future potential of your investment by looking at each tree separately. Number 2. Pay attention to earnings rather than adjusted earnings. He brought up that some businesses provide adjusted EBITDA rather than EBITDA to omit a number of expenses. Managers may argue that the stock-based compensation offered by the company is not an expense. He often quotes Abraham Lincoln on this subject, as once he wrote in a letter to shareholders asking how many legs a dog has if we also count its tail as a leg. The answer is 4 because calling a tail a leg does not make it one. Number 3. Retained earnings are significant. In a letter to shareholders, Buffett suggested common stocks as long-term investments. Keynes noted in his review that well-run industrial companies do not give their shareholders their entire profit. They keep a portion of their revenues and reinvest them in the company during prosperous years. Compound interest is one factor that works in favor of wise industrial investments. Buffett stated that before Smith's book, investors did not seem to comprehend why retained earnings were undervalued. Number 4. Risk assessment. Warren also discussed the disciplined risk assessment that his company's insurance managers adhere to on a regular basis. Number 5. Don't invest just for the sake of investing. He previously stated that his company has $144 billion in cash and cash equivalents since there were no worthwhile ventures to invest in the market. Therefore, unless they have a chance, people with money to invest shouldn't merely do it for fun. So now you know how to invest to build wealth fast. Share in the comments if you think we missed anything. Subscribe to keep yourself updated on the finance world. Thanks for watching. See you in the next one.